The truth about personal finance, what the Bible and historic academic research say is the best path to God-honoring financial independence. Our guiding verses for this study are Job 22:21. Submit to God and be at peace with him. In this way, prosperity will come to you. And from Hebrews 11:1, we read, faith is being sure of what you hope for and certain of what you do not see. And from Ecclesiastes 11:2, from Deuteronomy 8:17 through 18, you may say to yourself, my power and the strength of my hands have produced this wealth for me. But remember the Lord your God, for it is he who gives you the ability to produce wealth. And finally, from Job 21:16, but their prosperity is not in their own hands. Our 10th study in this series is asset allocation and diversification. Our guiding verses for this study come from Ecclesiastes 11:2. In the New Living Translation, it says, but divide your investments among many places, for you do not know what risks might lie ahead. And from Ecclesiastes 11:6, we read, for you do not know which will succeed, whether this or that, or whether both will do equally well. Diversification. This is what you get by investing in a broad-based stock market mutual fund or ETF, or a bond market mutual fund or ETF. You automatically own a diverse portfolio of stocks or bonds instead of having the risk of owning a few individual stocks or bonds. Broad diversification gives your portfolio a measure of safety as you own many stocks to buffer the occasional failure of a given company. And because, in the words of the late Jack Bogle, you buy the haystack instead of having to try to pick the winning stocks. Target date funds, the importance of asset allocation. Deciding on an appropriate asset allocation with appropriate diversification is the most important investment decision you can make. Why? Greater than 90% of your return on investments is based solely on your asset allocation. If you don't believe me, then open up your newspaper that tracks mutual funds and look at the target dated mutual fund returns for a couple of different fund families. These funds will be identified by a date that is supposed to coincide closely with your date of expected retirement. What you will notice if we are in a bull market, meaning the stock market is rising or making gains, is that the dated funds further out have higher returns, that those close to the date you are looking have lower returns. You should even see incremental change in the returns of these funds. Why? The answer is plain and simple, due to asset allocation, the amount of stocks versus bonds held in each fund. The funds dated closer to the date you are looking will be invested more conservatively with a larger portion of bonds, while the funds dated far away from the current date are going to have the highest stock allocation, making them more aggressive with higher returns in a bull market. Here's a look at target date funds earnings from December 30th, 2023, Star Tribune. So these are essentially year-end returns for each of the dated target allocations found on the left. So you can see that in 2020, the Vanguard fund returned 13.2%, while the Fidelity Fund returned 12.4%. As we go down and we look at 2050, here there's more stocks in the portfolio, and the Vanguard Fund returned 21.7%, and the Fidelity Fund returned 19.9%. These are exceptional returns for a target date fund for a given year. The point is, what I made before is, if you look at the dates close to the date your retirement is chosen, the returns will be less than the dates further out. This is due to asset allocation. The formula for determining stock versus bond asset allocation. The formula that is most often cited for the individual investor to determine their stock versus bond allocation is 100 minus your age equals the percentage of money you should place in stocks. Using the example of a 20-year-old, we take 100 minus 20 equals 80% in stocks and 20% in bonds. An example using a 70-year-old, we take 100 minus 70 equals 30 in stocks and 70% in bonds. With today's significantly increase in life expectancy and improved health care, I personally believe this is a bit conservative, making it more likely that you will run out of money at the end of life. For investors with moderate risk, I would recommend using 110 minus age equals stock allocation. And for highly risk-adverse individuals, I would probably recommend 120 minus age equals your stock allocation. Formulas for determining stock versus bond asset allocation. What God's word says in Genesis 6:3. Then the Lord said, "My spirit will not contend with humans forever, for they are mortal. Their days will be 120 years." Now don't place yourself in the high-risk, tolerant category until you have lived through a steep market decline and were able to maintain your fortitude, continuing to invest in stocks on the way down, at the bottom, and on the way back up. By a steep decline, I am referring to a 30 to 50% decline in the stock market as occurred in 2000, 2001, and 2008 through 2009, both of which shed 50% for stock funds, requiring a full 100% rebound to get back to even. Asset allocation is the number one driver of portfolio returns. The late Jack Bogle writes, "The most fundamental decision of investing is the allocation of your assets. According to a recent study, that decision accounts for an outstanding 94% of the difference of total returns." That 94% figure suggests that long-term fund investors might profit by concentrating more on allocations of their investments between stocks and bond funds, and less on the question of which particular stock and bond fund to hold. We read in Ecclesiastes 11:6, "For you do not know which will succeed, whether this or that, stocks or bonds, or whether both will do equally well." And from Ecclesiastes 11:2, "But divide your investments among many places, for you do not know what risks might lie ahead." William J. Bernstein, in The Intelligent Asset Allocator, asks a very important question. So how do you arrive at the allocation that will provide the most return with the least amount of risk? The answer is you can't. But don't feel bad, because neither can anybody else. One of the fundamental laws of investing, in the long run, you are compensated for bearing risk. Conversely, if you seek safety, your returns will be low. Experienced investors understand that reward and risk are inextricably intertwined. One of the most reliable ways to spot fraud is the promise of excessive returns with low risk. From Proverbs 3:24 through 25, we read, "When you lie down, you will not be afraid. When you lie down, you will sleep will be sweet. Have no fear of sudden disaster or of the ruin that overtakes the wicked." William J. Bernstein says, "Dividing your portfolio between assets with uncorrelated results increases return while decreasing risk." The point cannot be stated strongly enough. Mixing assets with uncorrelated returns reduces risk, because when one of the assets is zigging, it is likely the other is zagging. Sticking by your asset allocation policy through thick and thin is much more important than picking the best asset allocation. The essence of effective portfolio construction is the use of a large number of poorly correlated assets. From the Word of God, we read in Isaiah 28:13, the word of the Lord is to them will become, do this, do that, a rule for this, a rule for that, a little here, a little there. The key to success in investing is to invest with the asset mix that's best for you, considering your financial situation, your assets, income, and savings now and in the future, your age, your emotional strengths, particularly at market highs and lows, and your attitude toward market risk. Your knowledge of and interest in investing. Charles D. Ellis says, "Know thyself and match your investing to what you are and where you are in life, who you are and where you are in life. Know thyself." Charles D. Ellis, in his classic book, Winning the Loser's Game, Timeless Strategies for Successful Investing, writes, "Experienced investors understand 4 powerful truths about investing, and wise investors will govern their investing by adhering to them." Truth number 1, the dominating reality of investing is that most important decision is your long-term mix of assets, how much in stocks, real estates, bonds, or cash you hold. Truth number 2, that asset mix should be determined partly by your real purpose for the money, partly by when the money will be used, and partly by your ability to stay the course. Truth number 3, diversify within each asset class and among asset classes. Bad things do happen, and usually as surprises. Truth number 4, be patient and persistent. Good things come in spurts, usually when least expected, and fidgety investors fare badly. Plan your plan and play your plan, say the great coaches. And that takes us back to truth number 1. Rebalancing. William J. Bernstein says, an important assumption underlies all the portfolio discussions thus far, that at the end of the year, the investor rebalances the portfolio back to the target composition. If a particular asset has done extraordinarily well, its portfolio weighting will increase. Consequently, enough of it must be sold and reinvested in the poorly performing assets to return the largest composition, the target composition, the policy allocation, to the practical terms. It means rebalancing no more than once a year. So the point is, you want to maintain the allocation you set for your particular individual indication and rebalance once a year. Ecclesiastes 8:5-6 says, the wise heart will know the proper time and procedure, for there is a proper time and procedure for every matter. Burton Malkiel and Charles Ellis write, rebalancing reduces the volatility and riskiness of your investment portfolio and can often enhance your returns. Rebalancing simply involves periodically checking the allocation of the different types of investments in your portfolio and bringing them back to the desired percentages. It involves not letting the asset proportions in your portfolio stray too far from the ideal you have chosen as best for you. Investors who rebalance their portfolio in a disciplined way are well rewarded. Rebalancing will not always increase returns, but it'll always reduce the riskiness of the portfolio, and it will always ensure that your actual allocation stays consistent with the right allocation for your needs and temperament. Ecclesiastes 7:18 says, whoever fears God will avoid all extremes. And from Proverbs 21:31 we read, the horse, asset allocation, is made ready for battle, a down market, but victory, financial success, rest with the Lord. Model portfolios. The Merriman Financial Education Foundation Worldwide Ultimate Buy and Hold Portfolio. This is an extremely diversified portfolio and would be tough for an individual investor to maintain, but it is shown to produce outstanding market returns in all market environments. As you can see, there's a 10% allocation of the S&P 500, or what would be called a U.S. large cap blend fund, 10% U.S. large cap value, 10% to U.S. small cap blend, 10% to U.S. small cap value, a REIT index 10%, international large cap blend 10%, international large cap value 10%, international small cap blend 10%, international small cap value 10%, and emerging market 10%. A more simple portfolio that will gain you nice returns is to simply invest in a target date mutual fund and put 90 or 80% to 90% of your funds in the target date fund while investing 10 to 20% in a small cap value ETF to prime your portfolio returns. Model portfolios. The Boglehead 3-fund portfolio. The Bogleheads are followers of the Jack Bogle, who, when alive, invented index mutual funds and started the Vanguard mutual fund family. So Vanguard Total Stock Market Index is a 60% of the portfolio. Vanguard International Stock Market Index is 20%, and Vanguard Total Bond Market Index is 20%. This is Burton Malkiel's allocation ranges by age group. So this, you can look for your age, and he recommends, I'm in my 60s, 45 to 65% in stocks and 55 to 35% in bonds. I tend to be a little bit more aggressive, and I apologize for the slide on your screen. I prefer Charles Ellis's allocation ranges by age, which in your 60s is 70 to 80% in stocks and 30 to 20% in bonds. Conclusion. Target date funds are designed as standalone funds with an asset allocation and glide path appropriate for your chosen or anticipated retirement date. Asset allocation is something an investor can control and is the number one driver of portfolio returns. It accounts for approximately 94% of portfolio returns. International stocks belong in everyone's portfolio, as the United States represents less than half of the world's economic activity and stock market capitalization. You should rebalance your asset allocation at least once per year or any time your asset allocation diverges from your desired allocation by more than 5 to 10%. Optimal investment strategies must be age-related, appropriate to your risk tolerance, and investing time horizon. Action steps. Do you know the current asset allocation for your investment portfolio? Is it appropriate for your age, risk tolerance, and time horizon? If you don't immediately know the answer to these questions, research your current asset allocation using tools provided by your brokerage or fund family. If you're using an advisor that is doing this for you, give them a call and ask them the same questions. Number 2, action step. When was the last time you rebalanced your portfolio? Do you own a target date fund that automatically develops a glide path and rebalances for you, or have an advisor that is doing this for you? Action step number 3. How many uncorrelated assets or income drivers do you have as part of your portfolio? These might be stocks, bonds, REITs, cash, and hopefully not too many other types of assets, as they would become quite risky.